put your hands together for the CEO of Informal Systems and Cycles, Ethan Buchman.
All right, hey guys. This is, at this hour we only have the real heads. Everyone here is getting the deep alpha. That's what it's for. I thought I had 15 minutes, so I'm gonna have to talk super fast. So I'm Ethan, you may know me as the co-founder of Cosmos. We set out to solve big problems in blockchain infrastructure. I think we've had a pretty significant impact on bringing about the kind of landscape of blockchain design we have today. Lucky for me, Charles did mention Cosmos at one point in his talk, so represent. But I'm turning my attention now to another set of problems of settlement. Settlement and money are supposed to be the things blockchains are really good for. And there's deep problems in settlement around liquidity, how we manage liquidity, how we manage risk, how we achieve more capital efficient forms of commerce. And everyone of you, me, everyone in the world has to engage in the problem of settlement. Everyone has bills due that they have to pay. And so all of them are exposed to the problem of liquidity, of actually having the magic stuff that allows settlement to happen. And so it's something everyone needs, but it isn't something you can always have. And so just like our friend Juliet cried out for her Romeo so many centuries ago, the one man she needed, but just couldn't have because of larger systemic structural issues that got in the way, we cry out for liquidity, the one thing we all need, but can't always have because of larger structural issues getting in the way. And so if we want our story to end better than our old Elizabethan friends, we need to take these problems very seriously. So let's talk about my motivation. If you follow me on Twitter, I apologize in advance. I've been known to say such heinous remarks as, none of your tokens are money and you all have brain damage. Because it seems like we're trying to do something in this ecosystem about money, about the problems of money, and the best solution we have is to create these like pet rock store of value tokens that we scoot around on our little blockchains, and for what, right? And so I think we have to ask more fundamental questions about what money is, what it's for. And in my view, money is fundamentally about payments. Money is where the payments are. Money is for denominating and discharging debt, which is all, that's what a payment is. You denominate a debt, you discharge it. And in order to pay your debt, you need liquidity. Liquidity is literally the ability to pay your debt when it's due, right? When your bill comes due, can you pay? We all have to face that constraint. Every month, if not more frequently. And so as they say, you can be insolvent for a long time, but liquidity kills you quick. Now, some 15 plus years ago, some new monetary solution came on the horizon, this thing called Bitcoin, a peer-to-peer electronic cash system. And a lot of the cypherpunks looked up from their, decades old nihilistic nostalgia about the world and what they were doing. And they said, hey, is this the monetary revolution we've all been holding out for? And it hasn't really panned out that way. I mean, Bitcoin has introduced fundamentally important new technology. It's secured a fundamental human right to transact. But as far as the problem of liquidity, it approached it through this idea of just being able to transfer assets around, right? Whoever had access to Bitcoin would be able to discharge their debts in the future because it was a store of value. But there's a very kind of exclusionary approach to the problem of liquidity, very, very simplistic, and that derives from its, Austrian economic monetary philosophy, which is, frankly, in a state of arrested development. And so if we want to address this problem more fundamentally, we have to look at not just the assets, but the other side of the balance sheet, the liabilities. Every time you make a payment, you're discharging a debt. There's a pre-existing liability, and we have to think about that. And that's why we released last year the Cycles white paper, a peer-to-peer electronic clearing system, to approach the problem of liquidity by starting with the liabilities, offsetting the liabilities, right? And it turns out, when you start from the more fundamental primitive of liabilities and build a clearing system, you can actually build a cash system within that. So clearing is a more general concept than just cash. So I want to tell you a brief story, which is that for hundreds of years, banks have formed closed clearing clubs where they gather amongst themselves to pay off huge amounts of debt without using almost any money at all. And this is really, a major source of their power. But you and I, poor schmucks, we're not privy to these clubs. We don't get invited. We're outsiders. We're forced to settle our debts in cold, hard cash, cut off from the benefits, from the power of clearing and issuance that associated with it. And that's simply until now with Cycles, which allows anyone to clear their debts in a private, secure, and accessible way using any type of currency or credit that works for them, unlocking a new kind of capital efficiency that anyone can participate in, where the goal, ultimately, is to clear the most debt for the most people with the least amount of money. And to cement this as like the fundamental drive underlying our formulation of a new monetary and financial system. And so the way we do this is starting from first principles. It's not that hard. You just need to think from first principles. Debts don't exist in isolation. Like if I owe someone, they owe someone else, right? They exist in a network. And when you look at the network structure, the graph structure of the debts, the key point is that the amount of liquidity you need to clear all the debts is less than the sum of the total, because there are chains, because there are cycles of debts. And so this unlocks for us liquidity saving. This is the key to capital efficiency. You might know it as the velocity of money. The same amount of money can discharge, can be used in multiple transactions. We can apply that concept more generally. But it turns out we can take this further. We can actually represent every single asset as a debt from its issuer, right? This is obvious in the case of bank money. It's your asset, but it's the liability of the bank. But we could even, heaven forbid, describe Bitcoin in this sort of way. Bitcoin is my asset, but it's the debt of the Bitcoin blockchain. Now, the Bitcoin purists would be horrified for someone to speak in terms of, debts and liabilities existing on the Bitcoin blockchain. But representing the digital asset in this way actually allows us to incorporate assets into this broader network of liabilities and into the power of clearing and capital efficiency that it makes possible. I'm gonna skip ahead a little bit. It turns out there are 4 fundamental ways to settle a debt. And it comes from being able to look at this broader graph structure of liabilities and people's willingness to extend debts to each other and be in debt. And these 4 ways just come from simple properties of balance sheets, right? If you just stared at balance sheets for a little bit, you'd come to the same conclusion here. You can either reduce balance sheets, you can expand a balance sheet, you can transfer an asset, you can transfer a liability. That's it. Most of us are used to thinking in terms of transferring an asset. When I owe you money, I have a debt to you, I transfer an asset to discharge that debt. But if you have a debt back to me, then we can do set off, right? And so there's actually more ways to settle debts at a network level when we think about the network structure, and we could take advantage of that for great amounts of capital efficiency. And so when you put this all together, you get these very complex graphs with different kinds of currency and different credit that allow anyone participating to access new forms of capital efficiency, new economic opportunities, better access to credit, lower costs of working capital, and so on, that comes from looking at it in terms of a graph. And of course, to make this all actually usable, we need practical privacy. We use a combination of zero-knowledge proofs and trusted execution environments. Here we're standing on the shoulders of giants, the team at Zcash, folks at Penumbra and Anoma, and all those who have been working on zero-knowledge proofs and shielded pools for years before us. But using their tech and using their protocol design and using trusted execution environments, we can keep everything encrypted on chain while still doing our graph algorithms in a trusted execution environment and proving correctness with the zero-knowledge proof. So if you're interested in that, you can check out some open source software that's called Quartz. It's a framework for doing this kind of thing. And ultimately, the goal here is to enable private atomic multilateral settlement. This is the killer use case of blockchains, right? Next time your mother asks you, what's all this stuff about? Say to her, private atomic multilateral settlement. She'll know exactly what you're talking about. So, where are these debts that I'm talking about? Where are they? Are they in the room with us right now? In fact, they probably are. They're the wages you're owed by your employer. They're the rent you owe. They're the interest payments you have to make. They're the trade credit obligations you have if you issued an invoice or received an invoice. And of course, there's debts in crypto on chain and the DeFi economy. There's lots of debts off chain too, between different trading firms, right? Maybe if you trade OTC, you're given 24 hours to settle, something like that. Now, actually, that used to be a lot more common. But since the panic of 2022, a lot of the money and credit has kind of evaporated from our ecosystem. And so everyone is asking themselves, since this sort of existential event that we suffered through, how do we actually grow a healthy credit economy? What does it take to do that? And so we want to, again, think from first principles. This is fundamentally a problem of how you manage risk. And so our proposition is to start simply. Reduce the complexity. Start with the shortest term debts that exist. Those are the debts due today or tomorrow, within 24 hours, short-term deferred settlement obligations, and aim to clear them with the lowest overhead, right? And so if you're looking at this, and you might be from the TradFi world, you'd be like, oh, this sounds like a clearinghouse. Well, this is exactly what clearinghouses are for. The problem with clearinghouses is they have very high operational and compliance burden. They introduce a central counterparty and systemic risk. They require you to novate all your contracts and have, substitute the clearinghouse as a new counterparty to you. They require you to post collateral and escrow, and all of this just limits the accessibility and creates a lot more compliance overhead. So that's not going to work for us. Instead, what we're introducing is Cycles Prime, which is a capital-efficient clearing system for trading firms. No central counterparty, no collateral, no complexity, just savings, everything done in a fully privacy-preserving way that allows trading firms, whether you're a hedge fund or a prop trading shop or an OTC desk or an exchange or even a large prime broker, to actually benefit from reducing your daily obligations with others, saving on cash flow and increasing thereby your capital efficiency. So this is where we're starting. Our goal long term is to clear the most debt for the most people with the least money. But if you are involved in the trading world and you're interested in capital efficiency, saving money and reducing risk, which should be all of you, then reach out. We're launching a pilot. We'll be talking more about it this week, and we're inviting early participants. Thank you so much. I'm Ethan. You can check us out online. Take care.